Hello, fellow traders and investors. Welcome to the latest weekly edition of As Good as Gold. I'm Dylan, the research strategist at Pepperstone. We've seen a shift in overall market sentiments towards the positive side, especially in the second half of last week. This change can be attributed to increased market volatility, prompting investors to allocate more of their portfolios to gold for risk hedging. With several central bank meetings scheduled for this week, we will provide insights into the current state of gold and delve deeper into how upcoming data and events may potentially influence the gold price. Let's start by reviewing the performance of precious metals. Over the past 5 days, all 4 of them have appreciated against US dollar, while gold may not be the top performer compared with platinum, which surged by 2.8%. It has made solid gains, up by 1.1% in US dollar terms. Looking at the technical aspect of gold against US dollar, we can see it has been trading within a range. In the short term, 900 serves as a strong support level, while 1952 acts as a local resistance. Over the past 3 months, the range between 1884 and 1981 holds promise. Last Friday, gold against US dollar broke its recent downtrend that began in early September and also breached the short-term resistance at 1915. It's now on its way towards the previous high around 1952. Traders should keep a close eye on the Fed Open Market Conference scheduled for Thursday as a key risk event. While a dovish move without a rate hike is largely priced in by the market, the gold price's ability to return to 1981 will be influenced by any surprising development in the dot plots projections. Given the recent positive trend in gold, let's explore some potential long trading opportunities. British pounds appears to be an interesting choice. Gold against British pounds has surged from around 1528 last Thursday to approximately 1560 today, marking a gain of more than 30 points. The trend is robust, with the pair maintaining stability above the previous high at 1538, despite the narrow daily trading range of around 9 points. Gold against British pounds is moving closer to overbought territory. Additionally, gold euro has broken its downtrend over the past 10 days or so and is currently trading around 1808. This shift may be attributed to recession concerns in the Eurozone, triggered by contracted industrial production in July and also ECB's 25 basis point rate hike. A bullish flag pattern is evident in this pair, and if momentum continues, gold may potentially trade at 1844 in euro terms. Both trading pairs appear quite bullish at the moment, but we will need to see if gold's advantage persists after the UK CPI BOE meeting, as well as the release of UK and Eurozone PMI data. Stronger than expected ratings could rescue British pound and also euro from their recent underperformance and potentially drive gold prices back into the range. The driving forces behind gold's recent performance are primarily uncertainties, and these uncertainties are not necessarily originating from the US, but rather from the rest of the world. Several central bank meetings are scheduled for Thursday and Friday, including the Fed Open Market Conference, BOE, BOJ, SMB, Norges Bank, Riksbank, the Brazilian Central Bank, and Mexico, among others. While the market has likely priced in some of the results, the fear of unexpected moves in the near term is still motivating investors to hold gold in their portfolios. Furthermore, the cost of holding gold has slightly decreased compared to last week, with the 6-month US Treasury yield at 5.44% and the 10-year yield at 4.3% at the moment. Looking at the factors that could potentially weigh down gold prices in the longer term or by the end of this year, both the US and the Eurozone have adopted a higher for longer stance on the interest rate. While gold has shown resilience with strong support at 1884 against the US dollar, funds have been continuously reducing their holdings. CFTC non-commercial gold futures positions have decreased by more than 10% from their August highs, and the total gold ETF holding are at the new low not seen back to March 2020. Moreover, the software now prices the magnitude of the US rate cut in 2024 lower, from over 100 basis points to approximately 95 basis points. This suggests a higher terminal rate may apply, resulting in a higher opportunity cost of holding gold in the long term. In summary, gold's recent trend is driven by the market uncertainties. In the short term, upcoming risk events can push prices higher, but this might not be sustainable. And in the longer term, the US interest rate is expected to remain high for a certain period of time, supported by a strong labor market and high energy prices, with the soft landing trending narrative gaining credibility, the likelihood of a significant rate cut next year has been gradually priced out, which could lead to an increase in U.S. Treasury yields that can add pressures to the gold price. And for the remainder of the week, traders should keep a closer watch on central bank meetings. Again, although rate decisions are largely priced in, UK CPI and PMI, as well as Eurozone PMI data releases, could introduce more volatility if surprising results emerge. So that's all for this week. Stay tuned with Pepperstone.